where we are and where we're headed, I always like to look over my shoulder and see where did we come from. And so just instinctively, I picked up my phone. I was going to say I picked up the newspaper, but it's been a long time since I've done that. I picked up my phone and I subscribe to the two things I read religiously are New York Times and CNBC Market Watch. And, if you just look at the headlines in February, we had some of the typical things. We had shootings in different states, a gas line rupture in Texas. The Boy Scouts went bankrupt. I must have missed that. But the Boy Scouts filed for Chapter 11 bankruptcy in February. We acquitted Trump on both articles of impeachment. The Iowa caucus was delayed due to technical issues, right? So we had these things happening, terrible, terrible things in our country. But we got the first inkling regarding the coronavirus when the first American died of coronavirus in Wuhan. And at that time, this was early February, the report said the deaths are in the hundreds. And so that was sort of the beginning, right? And then we take a look at March, and we're going to see a lot more updates. I mean, yes, there are crazy things happening in the world, air attacks and suicide bombers, but my goodness, in March, Ireland canceled St. Patty's Day. Now, I don't know about you, but I have a lot of Irish friends, and this was huge, right? I mean, to cancel St. Patty's Day, you kind of started to get the inkling this was serious. I mean, Japan, Korea, Australia, everybody started going, other countries started quarantining. Now the cases are up to the 100,000 plus, but St. Patty's Day was canceled and Italy went into lockdown. So Spain went into lockdown because the First Lady tested positive. Italy had its worst day on March 20th. They lost 623 people. This, to the virus. And so prisoners are rioting in Colombia, but nothing really caught our attention more. How could it not, than what was happening? I remember the day when they said they were going to postpone they were thinking of postponing, Japan was going to postpone the Olympics, but countries said, oh, the heck with that. We're just going to pull out right now, whether you cancel it or not. So there's just a lot going on, and even North Korea we're still going back and forth regarding nuclear issues. But let's face it, by March, schools were shut down, Virginians were quarantined, and everything just changed as we know it. So last month to me was pretty pivotal. I mean, it was all about the virus, updates daily, number of cases. I'm getting a text every day that tells me the number of cases in Fairfax County. But across the nation, we started to really feel, I think, the industrial and the agricultural impact of the virus, right? Farmers began to panic purchase feed, for the fear that the people in the factories that produce the feed were going to get sick and not, and not be there to produce the feed to feed their animals. And, commodities like corn, started to tumble, right? And businesses began to truly shut down. The government stepped in and came up with a care package. And, a tactical shutdown in the UK actually caused a continent-wide shutdown of food services. So April was I think the height of this virus. But even in May, we were still looking at incredible job loss, right? Incredible numbers in terms of cases and deaths, right? But at the same time, countries and some states started announcing that they were going to reopen. And it almost, you know, as I look at this, it's funny, but I know this happened, but as I read it, I think, wow, you know, that is just, was so quick, wasn't it? I mean, we culminated all the way up into this financial, health, emotional, kind of perfect storm. And then we turned around and said, okay, well, you know, let's start to reopen, because we just can't, we just can't take it anymore, right? Our emotions are very high. The concept of whether to wear a mask or not has become politicized, right? You know, I was walking across the parking lot one day at the grocery store and I saw somebody's mask that I liked. And I thought, oh, I have mask envy. You know, just thinking, oh, I just coined a new phrase, mask envy. I like your mask. Where did you get it? But then like a day later, you know, Biden and Trump are going back and forth over, you know, should you wear a face mask or not in public? So, you know, emotions are high at best. Emotions are high. Now, right now, it's interesting. We're going to talk about the market in a few slides, but right now, pharmaceuticals are fueling the stock market because we all hope and pray for a vaccine. So, you know, job loss is at a high. Emotions are high. Things are getting a little wacky. Hurts, you know, this is typical to me. You know, large companies do this all the time, and I don't think it matters whether it's a virus or, you know, the sky is falling. If the sky is falling, the large companies pay out their bonuses and then they let the sky fall. So there was a headline about Hertz. Oh, I think one of the coolest things, though, is that even when the sky may be falling, we can always count on Apple and companies like Apple and, you know, Tesla and good old Elon Musk. You know, Apple is they're still designing the next generation of AirPods to have ambient lighting in them, so that in the future, they can probably tell us if we have an ear infection. Isn't that awesome? So, and then Elon Musk, his SpaceX company, he has SpaceX and Tesla. SpaceX is launching its first ever space mission today. So, you know, this is resilience to me. This is as bad as it can get here in this country. We just keep putting one foot in front of the other, and we keep pushing forward and doing the best we can, no matter what. So I was really happy to see these actual two headlines here for Apple and SpaceX were this morning. You know, some of these were over the month of May, and a few of these are actually from now. But what is the very first headline I read when I wake up? Today, Governor Northam announced that Northern Virginia will be joining the rest of the state in its first phase of reopening on Monday, May 29th. I got up and I read that before I read the market updates, and I said, wow, look at this. The criteria for opening in Fairfax County, a downward trend of positive test cases for over 14 days was one criteria. A downward trend of hospitalizations for over 14 days, second criteria. An increased capacity for testing and sufficient hospital beds and ICU capacity. So we met the milestone benchmarks, we met the criteria. However, we still need to meet what's called contact tracing. And Fairfax County's hiring a company to do this. And as a matter of fact, it's going to probably bring several hundred jobs to Fairfax County. And these are the people that have to go out, maybe more by phone calls, but touch everybody in Fairfax County so that we can track the virus and trace it from person to person. Because if we don't do that and we open up, you know, we could have serious problems. I thought it would be helpful. I mean, I looked it up and I thought you might want to see this. This is actually right off of the Fairfax County the Virginia Department of Health website. And this shows us the state of Virginia, the number of confirmed cases in the dark blue and the probable cases in the light blue since March 1st. Now, the 7-day moving average is really where we want to look at the trends. Now, for the state of Virginia, we really don't have a 2-week downward trend. We've got a flattening of the trend. And I'm not, believe you me, I am not a healthcare professional, but I do a lot of analysis with charts and moving averages. And so when I look at this, I think, well, I don't know. I think we might, we maybe should give it a few more weeks, right? If I need 4 weeks of a downward trend in my state, let alone my county, that would put us back to April 30th. And the trend is really flat. It's not very down. It's down here in the last week. But I would see the trend being more from May 18th out. Now, that's just Lynne Celia's personal opinion. It's not a professional opinion. I'm not a healthcare provider. But what that says to me is that as things open up, we need to still be vigilant, right? And there's plenty of good, reliable information on the Fairfax County website. Okay. But until I see this arrow really tilt down for the state and for Fairfax County, right, I'm going to be very vigilant for myself and my family. This is the website, virginia.gov, coronavirus. Forward Virginia is the plan, right, by the governor. And so as of this Friday, Fairfax County will start to reopen. And I thought this was big to, it just hit this morning, and I think it sets the tone for this workshop, the presentation. If we look at the market headlines today, right, the Dow is pointing to a strong gain, right? Optimism about the reopening of the economy builds, and airlines and cruise lines are going to lead the way because they've been the most battered, right? Europe unveils a $1 billion coronavirus economic recovery fund. Spain is going to start providing a regular income stream to the citizens, right? And Congress will probably have to pass another stimulus bill. Interesting, housing markets. Housing markets are, oops, I'm sorry, I think I went one too fast. Yeah, housing markets are picking up. New home sales rose slightly in April. So we've got a lot of interesting headlines here. Positivity, things reopening. Goodness, my old alma mater, West Virginia, is reopening bars. I don't, I'm not sure I would go into a bar right now in any state. Alcohol and social distancing, they're just what do you call it? Opposites, right? So I don't know, but I think we clearly have signs that people want to get back to normal. Whether or not we can, whether or not we're successful, I think that, I think that's to be decided. So what's next? This is again, my opinion, my professional opinion. I think we're obviously going to hear less and less about the virus until cases begin to rise again. And I hope and pray that they don't. But I think the virus is going to slowly give way to the elections that are coming up, right? The elections are going to take over the headlines. I think we're going to see merger and acquisition activity. I think the large companies are going to be buying up the less large or mid-sized companies that have experienced a lot of trouble and maybe failing as a result of the virus. So I see a consolidation across certain industries. Political and economic divides, I see them becoming greater. I mean, we can't even all decide whether or not we should wear masks, and our leaders can't decide. So clearly, as individual citizens, we're going to have a hard time with that. The economy, I think that the well-off will remain well-off, and the people who have a hard time financially are probably going to see things get worse. And I do believe jobless claims will increase. As we reopen, it's just going to be more obvious and more solidified as who opens and who doesn't reopen, right? We've been going on the assumption that when we reopen, we'll do it gradually, but at some point in the future, it'll be, everybody will be, quote, open again. That's just not going to happen in my humble opinion. And I do think that we will see another correction over the next 12 months. I think we'll see it. Is the worst over? Well, worse is a relative term, I think. Let's talk about the markets, okay? This is a picture of the Dow Jones, right, in 2020, as of the close yesterday. And here we were back in February with the market high, the Dow Jones at 29,551. We heard about the virus. The virus came in February when we were looking at the headlines there. The first American died in Wuhan, and all the way down to March 23rd, we hit a bottom of 18,591. That was a 38% drop in less than 4 weeks. So people that were all in the markets really saw a big hit. Now, we turned right around, and in the about the past 4 or 5 weeks, the market's up 38%, 35% from the bottom. Now, from one of my prior workshops, you'll know that when the market's down 38%, you have to gain a whole lot more to get back to your starting point because you have less invested. So a 35% gain in the market brings us back up to 24,995. Well, as you can tell by the graph, that's really just about halfway there. We've recovered, if we talk just about the 38%, we've recovered 15% of that. Halfway would be about 19%. But we've made incredible, in 1 month we dropped 38%, and in the next month we go back up 15%. And as you can see here, we're actually holding pretty steady at this, right? When I actually used this slide a month ago on April 30th, and we're up about 2%, a little less than 2% from a month ago. So that's pretty steady. And what does this mean to you? Well, if you didn't sell, if you didn't panic sell, you would have recovered almost half of your losses by now, right? You would have gotten back that 15% gain out of a 38% loss. Now, whether you did nothing or maybe you panic sold, right? That's all in the past. You can't think about that now. But today, moving forward, is a really good time to take some of the money off the table. The 15% gains. If you're ever going to make a move, I would suggest doing it now. A lot of people froze when the market dropped, and rightly so. I don't want to move any money now. I want the market to come back, and then I'll make a change. Well, we're almost halfway there. I think probably by close of market today, we might be halfway there. But the question is, do you really want to wait until we hit that 29,000 mark again? Or do you want to take some money off the table now and reallocate and do the things that you kicked yourself for not doing, back in February when the market tanked? So you know, in terms of the financial markets, we're up, we're almost halfway there. And in terms of investing, I would say, you know, in such a relatively short period of time, we are getting indicators that say, you know, we want to get back to some semblance of normalcy. And the markets are supporting that, right? And do we want to take advantage of that? So take a second, think about it. You've got to look at your years to retirement, how much risk, safety, liquidity, return. These are all the things that we talked about in the first workshop. And if you want to review that, you can, it's online, it's on my website, and you can just go back and play it. I think this workshop today will make a lot more sense if you actually listen to the first two workshops in the series, although I think it's good in and of itself, standing on its own. I showed this slide also before, a flight to safety. Just in the TSP plans alone, $15 billion moved out of the growth funds into the G fund, which is his government treasuries. This $15 billion is going to start to come back into the market. It is coming back into the market right now. Okay, it actually is it has already begun. Okay, will a large decline happen again? Well, I believe it will, but honestly, you know, there's no crystal ball. I would like to be wrong about that, and whether I'm wrong or right, I don't believe in market timing. I just think everybody needs to be prepared for it. Now, I showed this also on a prior workshop, but it's just, you know, we've already had a negative 38% decline. On average, these occur, you know, about once every 3.5 years. Now, the average length of the decline is 338 days. Well, our decline in only a month is back 15%. So, you know, we're definitely doing some things here that we've never really seen before. It's a real quick recovery. I think if we're going to get another correction, I think it's going to be more in the 10 to 15% range. And again, I think that's just a buying opportunity. If you're allocated correctly, keep some cash on the sidelines, and when we see another dip, you want to take, you know, you want to take action and you want to buy. If you need money to live on, you shouldn't be in the market. It's as simple as that. So the big question from an investing perspective is, do I wait, you know, for the market to come back to its original level back in February? Or do I reallocate now? And, you know, I believe you should reallocate now, okay? And you can baby step in by using some methods such as dollar cost averaging or value averaging. And I'm going to talk about that in the next slide. But really, you should check your asset allocation, right? Based on your age and your goals. Begin to reallocate and reposition your money now and continue to rebalance it to hold those same allocations. I think, you know, you should consider putting some annuities into your portfolio to replace the fixed income bond portion, because they really work to reduce the portfolio's overall risk. And sometimes they can even get you down to zero risk. And then slowly wade back in to the market over a period of 6 to 12 months. That's, you know, for people who are retired within 5 to 7 years. Now, retired or within 5 to 7 years of retiring. If you're more than 5 years from retiring or 7 years from retiring, whichever you're comfortable with, I wouldn't change a thing. I would continue to invest regularly. Always revisit your goals based on your age, your tolerance for risk and time frame. check the diversification and asset allocation, and rebalance regularly. This is a very important slide. I think right here, if you are within striking distance of wanting to retire, this is not nearly, in my opinion, as bad as 2008. Now, we don't know what the future holds, but you know, you don't usually get second chances this quickly. So you've got 15% on the table now. And I suggest really giving some thought. If you're within striking distance of retiring, or you're already retired and you're in the markets, I think you should begin to reallocate and rebalance now, right? And get the risk in your portfolio down, because we really don't know what the future holds. And we've managed to recover pretty darn quickly. Dollar cost averaging and value investing. Two very different things, but I think it's worth spending a couple minutes on it here, because it's a very fundamental concept. You know, in this example, we're talking about a person that wants to put $4,000 of cash, right, back into the market. Now, the first thing is lump sum investing, right? I've got $4,000 and I'm just going to put it in the market today. I'm going to buy $4,000 of this stock at $10 a share, right? So I'm going to get 400 shares. Dollar cost averaging says, now you can do it monthly or quarterly, but it is usually done within 6 to 12 months. Dollar cost averaging shouldn't go higher than 12 months, right? So here we're going to go quarterly. We're going to put 1,000 in every quarter, and whatever the market price is for that share, I'm going to buy 100 shares, and then in quarter two, I'm going to buy another $1,000 worth, but the price has gone up to $12.50, so I can only purchase 80 shares. You see, fixed amount invested. And then the market price or the share price dictates how many shares I can purchase. So if I dollar cost average, and I'm going to say dollar cost averaging reduces risk the most, okay? If you're close to retirement or you're retired, I suggest you dollar cost average and not value average or value invest, because this is the least risky way to get back into the market, right? Everybody says, oh, if I put all my 4,000 in now and then it goes down, right? It's going to go down, it's going to go up. We just don't know when. So do it a little bit in regular intervals. Value averaging, or value investing, it's called, it's different. You say, look, I'm going to require that at the end of each quarter, right? I want I want my portfolio to be at this level. So here, at the beginning of quarter one, and it's $10, at $10 a share, you can buy 100 shares. Okay, here, the price goes up to $12.50. So your 100 shares are worth $1,250. So instead of putting in $1,000, you only need to add $750 because the price has gone up to $12.50. That will bring your portfolio to $2,000. You'll have 160. Now look at this. Oh my goodness. In quarter three, the price goes down to $8. The value of my account has gone down, right? It'd be $8 times 160 shares. It's gone down to about 1,200, right? 1,280. If I want my account to be at 3,000, I need to invest 1,270 at $8 a share. I have to purchase 215 shares to bring my account up to 3,000, right? So dollar cost averaging, you're buying $1,000 worth of the market each month. Based on the price of the market, you're going to get so many shares. Opposite of the value averaging says you're going to invest different amounts of money depending on the share price, because you want your portfolio to grow in value by $1,000 each quarter, value investing. And you can see down here that at the end, your average cost per share is higher with DCA, and your value is higher, but your gain is less. So hence your market value is higher and your risk is less with dollar cost averaging. That's why if you're retired or you have a short time frame, to retirement, you want to do dollar cost averaging. If you're further out and you still want to keep investing regularly, but you're a little skittish, I highly recommend value investing. It's an incredible way to do it. Okay. So if I keep saying asset allocation, what is it? Just a quick refresher. It's the process of dividing your money up across various investment categories, right? So depending on your age and your goals, should you be in stocks or bonds? Should you be in mutual funds or ETFs? Should you have some annuities and some life insurance in there? What are your goals? What's your tolerance for risk? What kind of returns are you looking for? And over what time are you investing? This one decision does more than any other to determine how much money you could earn. Okay? And how much you can earn and the probability of earning it, right? Because the probability of earning it is risk, right? How much money you earn is return. The probability of earning that return is risk. So asset allocation, please take this very seriously. We have a few rules of thumb, okay? For growth, 100 minus your age is the percent that you should be in stocks, in the markets. So it's not uncommon for somebody in their 20s, 30s, or 40s to hold 60 to 90% of stocks in their portfolio. Okay? If you're older, then obviously the percentage of fixed income or guaranteed income is going to be more than stocks. So people in their 60s, 70s, right? Not uncommon. You should hold 50 to 80% of fixed income bonds and annuities, right, in your portfolio. Rebalancing is taking a look at your allocations and always keeping yourself on the same guideline. Excuse me, take a sip of water here. If this is the mix that you and your advisor come up with, or you do it on your own, you need to stay true to this. And because the market goes up and down, and we're very up and down. I mean, this is one of the most volatile times that I have seen in 40 years. I've seen a lot of market ups and downs, but this is volatile because it's happening so quickly, okay? I mean, I've been invested in the 1987 correction, the 1991 correction, 2001 tech bubble, you name it, the Great Recession. But this is volatile because it's happening very quickly. So you got to reallocate, right? If the market goes down, your growth funds are going to go down in value and they're going to be less. So you want to reallocate and get yourself here, which means you have to buy and sell some things and true it up to your original asset allocation mix. So asset allocation and rebalancing. All right. Is the worst over? Well, Last month, April 30th, when I did the workshop on financial wellness, I introduced this index. It's called the VIX, VIX, Volatility Index. And it measures the frequency or the rapidity or rapidness, right, of the market's ups and downs. And the volatility index was tracking right along with the market. The blue, right, is the number of countries with higher than 5% growth rate in the daily number of confirmed cases. So the blue is tracking the virus, the coronavirus. The red is tracking the VIX, which is the volatility index, right, of the market. They're hand in hand. The more cases that we uncover and identify, the more volatile the market becomes. They're going hand in hand. Now, this is incredibly eye-opening, and I pulled this off of the market news today. And what it's basically saying is that the volatility index of 2018, which was the Great Recession, when we had complete and utter destruction of our financial markets, right? Mortgage-backed securities, collateral-backed securities, right? I mean, just financial markets falling. I mean, the sky was falling, definitely, in 2008 from a financial perspective. If you look at the volatility index, it was really more, it was very flat. It was really more of a dramatic collapse or decline in the market than anything else. But look at the 2020 volatility index. So, back in 2008, if you remember, the largest decline in equities was over 50%. Well, it was like 54% if you were holding all equities, or any equities was 54%. Here, our decline was 38%, and we've recovered 15% of that. But look at the volatility index. What is driving the difference here? Why? Why is the volatility index? Well, the volatility index is really tied to fear. It's not tied to numbers. Volatility is tied to fear and stress. And this is my segue into, as we wrap this up, to talk a little bit about financial wellness, right? Financial wellness, right? I personally cannot talk about the markets in any capacity without talking about financial wellness, right? What is it? It's the belief that you have enough money to do what you want to do. It's the absence of money stress. You don't routinely worry about money. It's significantly related to your overall well-being, right? Now, when I did the financial wellness workshop, a lot of people came back to me and said, wow, I never realized, Lynn, that, financial stressors were there before the virus, right? So were people more stressed out? Yeah, but were they more stressed out about money? Well, yes, but was finance the only factor? Financial wellness, most people think of it as, I don't want to have money stress. 34% of people that were surveyed in 2019, thousands, said, I don't want to have financial stress. The second was, I don't want to be debt free. And then I want to have enough, emergency savings and some financial choice making, some freedom in my choices, but, at the end of the day, financial wellness means different things to different people. I have coined a word wealthy. I'm not the original inventor of this term. But believe it or not, I came up with this term and then I Googled it and I said, oh, this is not original thought, Lynn. But I did think of it on my own and I love it. I ask people, are you wealthy? And this is really a discussion of wellness, health, and wealth. And can you really have one without the other? Are you wealthy? Okay. Now, there are many ways to be wealthy. Some break it down very simply: physical wellness, mental wellness, financial wellness, social wellness. You know, I tend to use 4, but I would replace social with spiritual: physical, mental, financial, and spiritual. Right here we add cognitive and environmental wellness. I don't get this nitty gritty when I talk about wellness. Social and cultural, career, academic, environmental. Here's a few more: vocational, right? So, you know, again, it means different things to financial wellness means different things to different people, but overall wellness also means different things to different people. Now, last month, I put this slide up and said, you know, here we are in the context of COVID-19. Everything is at issue. Physical health, unprecedented. We're afraid of leaving our homes, getting the virus, and dying. I'm not sure we could get, you know, more worried about that, which is actually our emotional health as well. But people are dying and are still dying from this virus. So people are getting sick. Physical health is at risk. Emotional health, well, we're worried about getting sick. We're social distancing, isolating ourselves, quarantining ourselves, and watching way too much Netflix. You know, our emotional health is suffering. On top of that, we've lost income because we've been laid off, or we've lost, you know, wealth in the market, right? So we may have lost our day-to-day income. We've seen our investments go down 30%, 40%. It's just not been good. And so if I look at, are you wealthy, right? Health to me is physical and emotional combined. Wealth is money, finance. And it's interesting. It hit me like a ton of bricks when I realized if we think about that volatility index, it's all because of fear. Fear is what has been driving the volatility in the market. That's it. It's an incredible, you know, again, in the context of the volatility index in 2008, it was flat because this is what was happening. Our financial health was being affected when the market collapsed in 2008. I mean, sure, people lost jobs, but that wasn't the primary problem. You know, Lehman Brothers went out of business, but somebody bought them. Bank of America, Merrill Lynch, everybody. I mean, you know, it was crazy, but it was largely a financial issue. Now we have a market decline, a highly volatile market, but it's primarily driven through fear, which may explain why the market's coming back so quickly. Because emotionally, we've had enough. We want to get back out. We want to get back outside. We want to get back to work. We're all going crazy after about 2 months of isolation. And there's nothing wrong with that as long as we do it smartly, right? Social distancing, wear masks, etc. So once we can get a handle on the fear, maybe get a vaccine in place, start to get out a little more, markets recover, make some changes in your portfolio, I've got to think that we'll get back to normal. All right, sometime in the next 12 to 18 months. So to recap, we talked about the markets, right? The ups and the downs. We've talked about how to get back into the market if you sidelined, if you jumped out and you have some cash on the sidelines. We've talked about wellness, and I hope you understand the impact of understanding what's behind this market right now. That it's much more fear driven. The volatility index is an index of people's worry. And honestly, you know, health always takes precedent over wealth. You can have all the money in the world, but when you're sitting there on the edge of your chair and the phone rings and it's the doctor's office with some test results, there's no amount of money in the world that can make you feel better. That's why we are where we are today, right? Health takes precedent over wealth, right? So, you know, I think during this pandemic, right, we're certainly not out of it, but be cognizant. Check in with yourself physically, emotionally, and financially. Now, if you have other wellness factors, include them here, but check in with yourself on a daily basis. How are you physically? How are you emotionally? And how are you financially? Reallocate now while you've got that 15% recovery on the table. Continue to save and invest if you can, and revisit your financial plan and create one. And after the pandemic, I just say see above, because honestly, if we have good healthy habits, you know, and if we're overall we have a good high wellness factor, then you really need to just stay the course, right, and keep doing what you're doing. Okay, so with that, stay calm, stay invested, and stay well. I think we can open it up now for questions. Got a few minutes left if anybody wants to ask any questions. And if you don't, I'll just put this up. Oh, this is one of my Lynneisms. I always like to say this: rest assured, if you don't make informed, educated decisions about your money, someone else will be happy to decide for you. That's pretty much what I founded Celia Financial on, was really helping people make informed, educated decisions for themselves. Even if you're working with an advisor, a financial advisor, you still need to be educated, all right, to interact with financial professionals more effectively, right? You can contact me by email. You can go to my website. You can book a meeting with me. You can take a look at some other workshops that I've given. I've got the video recordings on my website. Don't forget, we have another financial literacy series workshop on June 18th. And with that, I'll say thank you very much, and ask Renee if we've got any questions.